Do you want to go ahead and introduce us, Ken?
I sure will. This is Ken Cabolo from the Mid-Michigan chapter, and this is the Mid-Michigan Roundtable. There are usually 4 nights of the Roundtable. Mark Robertson from Rochester, Michigan, Hugh McManus from out in Pasadena, California, Cy Lynch from Atlanta, Georgia, and myself from north of Flint, Michigan. Tonight, Cy is doing some ministerial duties in Atlanta, so he will not be with us. But the 3 of us will hold down the fort, and we hope to give you some good information. And along the way, we're going to present 3 stocks. So sit back. We usually plan these things for 60 or 70 minutes, but rest assured, if you have a question, Mark and I at least will stay here until all the questions are answered. So don't be afraid to type something in the text box if you have a question, or if you need to and want to talk with us live, don't be afraid to raise your hand and I'll unmute you at that particular time. So with all that, let me introduce my good friend Mark Robertson. Mark, why don't you take it away?
Thanks, Ken. All right, well, just a couple of things with the cover slide. Again, that quote up at the top is actually from my stock presentation on Home Shopping Network tonight, and it's from Joy Mangiano. Something special when creative people get together. I extend those remarks to when groups of like-minded long-term investors get together. I really do think we accomplish special things, and this forum is an example of that. We're coming up on our 7th year, ready to start our 8th year, and everybody's to be commended. The second item of business here is that is not photoshopped. The photobomb by the Irishman in the middle. Some people accused me of photoshopping him in there. Didn't use Photoshop. He just in the middle. And others have noted that he seems to be bubbling, that there are bubbles coming off of the...
Oh, yeah. I finally took a bath.
There you go. All right, let's get the legal paperwork out of the way first. No investment recommendation whatsoever is intended by what we do here tonight. This is all about education. It's also about demonstrating and laying out and sharing the methods and the analysis techniques of the modern investment club movement as brought to life by the National Association of Investors, Better Investing, and Manifest Investing. So we're really just doing this to demonstrate, to illustrate a technique that has now been used by those of us in the community for now over almost 75 years, if you go all the way back to 1941. We could own a few stocks in the portfolio. We generally will call that out and could be actually held in our personal portfolios. Here's our standing agenda. The knight on the left has actually lost a couple of pounds, so maybe we need to thin him down a little bit. But this is the standing agenda. Welcome, especially a extra big welcome if you're joining us for the first time. We do try to keep this fairly informal, and as Ken was saying, you can participate via the question pad or by raising your hand and going live audio. We're going to take a look at the results. Quick reminder of what we've been trying to do here over these last 7 years. We do have a couple of challenge stocks that we're going to lay out on the carpet. I'm going to present Home Shopping Network, ticker HSNI. He's going to bring Bristol-Myers Squibb. Ken's going to cover a repeat selection with MAXIMUS, MMS, and Bristol-Myers is already in the tracking portfolio also. We do have an audience poll. Again, even if you're here for the first time, everyone is invited to vote when we get to the audience poll after we make the selections and the presentations. And there's an open Q&A at the end. We try to, as Ken was saying, we try to wrap up in 60 to 70 minutes and then stick around for a few minutes of questions and answers. Here's a reminder of what it's about. Again, for 7 years, we've been kind of gathering on the last, in most recent history, in the last Thursday of every month, sharing an idea.
This is Tuesday, Mark.
Oh, what did I say? Thursday?
Yes, you did.
Well, it's been Tuesday for a long time, hasn't it?
Okay.
All day. Okay. So Tuesdays, and I didn't change the calendar. So on Tuesdays we've been doing this, and again, just to share an idea, to share what the analysis looks like and try to build a portfolio which over the long term beats the market by 5 percentage points. That's 500 basis points. So again, we're trying to outpace the general stock market as measured by the Wilshire 5000. And we do like to see over half of our selections actually outperforming the market during their holding period. We want their holding period return to be greater than the Wilshire 5000. Here's a look at our results. Again, I think the trend is in the right direction. We want to get up to that dotted line. Again, relative return is simply the difference between actual returns if we had invested them in the Wilshire 5000 versus the actual returns. We'd like to do better than zero. That means we're beating the market anytime we're above zero on this chart. And we really want to beat it collectively and over the long term by those 5 percentage points. That's what investment clubs strive for. Again, anytime you get up above 2, you're in kind of rare company. The number of mutual funds that live in this area is actually quite rare. And we want to get up there and as far up as we can, and we seem to be making pretty good progress. I think the portfolio is positioned very well right now for another pretty good run. You can see that the outperformance accuracy is nudging up right against 50%, and that rate of return, that's the absolute rate of return. Same way that investment clubs keep score with their portfolios, same thing we do here, 12.3% over the long term. Any questions or comments on that, Ken?
No, we're clear so far, Mark.
Here are the stocks that have enabled that so far. Again, over 7 years, some of these are repeat selections. In the case of Cognizant Technology, I believe it's been selected 12 times. You can actually go to this public link and there's a legend which shows you how many times each one of these has been selected. In the case of Cognizant, the 12 time selections, most of them by Cy Lynch. What we do every time a stock is selected by one of the 4 knights or a guest damsel or a guest knight or the audience, every time that decision is made, we invest $1,000 into it. And you'll see that as we review a couple stocks here in a minute. So $12,000 in Cognizant has become $18,000. So what you're looking at here is, stocks that have been repeat selected, most of them with just a couple of exceptions on this list. $1,000 or $2,000 has become the type of numbers that you see here. And some of these up at the top, Apple's been selected 7 times, so 7,000 has become nearly 16,000. Some pretty good, interesting names on there. I'm just thrilled to see some kind of off the radar. The companies with the asterisks are companies that are not covered in the Value Line Standard Edition, so they've got the asterisk. It's always good to see those type of companies up at the top. I'm reminded of how well we as a community did with BioReference Labs here over the last few years. Again, a name that's not heard quite as often on TV and that sort of thing, but delivered fabulous returns to us. And we're always on the lookout for that type of company to bring here and present. Any comments or questions on any of these, Ken?
Well, I think that, Mark, it's so interesting to see some of the picks that we've only picked once or twice move into this list of the most valuable. Maybe what we'll do next time is actually add a notation after the name about how many times they've been picked, so folks can see how many of the short picks have actually made it. And then it's also just amazing to look back and bow down to Mr. McManus for some of his choices that at the time appeared to be kind of off the wall. I mean, I'm looking 6 or 7 down the list at Bank of America, for example. What a wonderful choice. When everybody was running away from the banks, Hugh was telling us that we should be investing some money in them. Hugh, I'm glad I listened to you and put some personal money into some of the money center banks. I've been extremely pleased with that.
Oh, good.
I noticed that Caterpillar is another one. While it is on this list, isn't it?
Yeah.
About halfway down. Caterpillar is another one that Hugh began investing in when everybody else didn't think that it had any more chances to make money. It was up really big time today, and that's not reflected in this slide, but It took a really nice jump today. I noticed 5, 6, 7% at one point. So I think that all of the different styles that we're talking about, and I've certainly learned a new style from Hugh that while I don't use it all the time, I'm certainly attuned to the idea that Mr. Nicholson said you can put 20% of your portfolio into non-traditional holdings. And so when I put money into a money center bank, I actually bought JP Morgan, not Bank of America. But when you put money into something like that, when everybody hates it, that's certainly a non-traditional investment. But there's certainly some value to remembering that some of these things are probably going to be here when the dust settles. I think Caterpillar is another wonderful idea as well. So I'll quit jabbering, Mark, and let you go back to you, okay?
Well, I thought I just might mention and give Hugh a chance to brag a little bit. Amazon is on this list. And checking the tote board, I think Amazon's been selected twice. And one of those selections was made at the National Convention in Chicago, I believe 3 years ago.
Yeah.
When we did a roundtable live, and Amazon, as you may remember, Hugh, didn't get any votes from the audience that day.
Yeah.
It's one of the best performing stocks in the stock market since that day.
Yeah, I prefer votes from the stock market myself, but there you go.
Yeah, it performed pretty well. Some of your picks have been beyond the pale, but they certainly are doing pretty well.
Mm.
For those of you wondering, and I do know we have a few new people here. In February, we have an awards program. So a couple months ago, we hand out our Golden Knights, and Hugh was still leaps and bounds ahead of the field in terms of long-term performance, much of it on somewhat unconventional picks of pick made in good faith in Bank of America back in the depths of the crisis, or after the depths of the crisis. So.
Now, of course, the flip side is you have to look at a company called Staples.
Yeah, in fact, we were talking about that. We might.
Purposes of full disclosure.
I mean, there were times when you were actually up huge in Staples, and we probably should get out a way to alert our way out of that. We need to work on that. We'll come back to that.
Well, I still believe that industry, even though the Justice Department, or was it a court, decided that it couldn't merge. A merger has to happen there. It just has to happen, or else, well, Staples is now exploring selling itself. A merger with Office Depot would make a lot more sense.
Mm-hmm. All right, so let's go ahead.
I did make, Mark, I did make a resolution about a year ago that I was going to stop worrying about repeating some of my really good ideas. I had been trying for a year or two during a time where I wasn't really doing very well in this stock picking contest here, but I had been trying to come up with a new stock every month, and I've decided that it pays to repeat some of the best ideas. I think one of the things I regret more than anything else is choosing NetEase 4 or 5 years ago and then only choosing it once and letting it kind of go by the wayside when I probably should have chose it 6 or 7 or 8 months in a row. It's been one of the best performing stocks in our Model Clubs portfolio, and it certainly is a great performer here. I mean, what we're looking at in this NetEase growth here, I think it's worth about almost $6,000 today. What we're looking at is basically based on only 1 or 2 picks, not 10 or 11 or 12.
It's just one selection, Ken.
One selection. So I wish I would have picked it 4 or 5 or 6 times, you know.
And again, people in the audience, if you go to that link, you can actually break down and see what the companies are. Amazon is a 2-time selection right here. The one in Chicago, and then Hugh must have repeated it one other time. So that one's pretty phenomenal. Panera is just a couple time selections. We're going to talk about that. We're going to show that in great detail. And the other one that just I love this one, Universal Display. That's a 3-time selection. That was Ken and I both picking it one night in the audience, seconding or thirding the recommendation. You can see that one's almost up to 10,000 now. It's good stuff. Let's go ahead and dig into some of the challenge criteria here. So, Ken, why don't we go ahead and start? Why don't you kick us off with just taking a look at what the portfolio needs? So talk portfolio centered for a minute, what conditions the portfolio in, and then we'll go
Okay.
into the challenge.
Well, I'm directing everybody to the bottom of these columns where we're coming up with weighted averages for all of the stocks in the portfolio. Because of the size, we can't display all of the stocks in this tracking portfolio. This is not the kind of portfolio we would recommend that you put together as an individual. This is a tracking portfolio, keeping track of all the ideas that we've put forward. But you can begin to manage it like a regular portfolio. The par is a little bit low right now. It's 9.9%. And if you look at the average for the market right now, it's around 6%, maybe a little bit less than 6%. So I'm doing some arithmetic in my head. I want to beat the market by 5 points. So I'd like to be up maybe a little bit less than 11% in par. So I'm about 1% shy when it comes to the potential average return. I do have good quality stocks in the portfolio. All of these averages are weighted averages. So a stock like Cognizant that we've chosen lots of times contributes more to these numbers than a stock like, like NetEase that we've only chosen once. Our predictability, our earnings stability, how straight is the blue line, it's a little bit low for my tastes, but that comes, I think, from some of the non-traditional choices that we've put in and basically because of Hugh and become very successful with companies like ConocoPhillips, like Caterpillar, like Bank of America. So that gives you a little bit shakier earnings stability line than you might have if you were investing everything in up, straight, and parallel. But we have wonderful financial strength in this portfolio. These companies that we're choosing are some of the safer companies. They have great balance sheets. They have a handle on their debt. And that's what we like to see. That's a little bit better yield than I would expect to see in a random portfolio of choices from 4 or 5 or 6 different people. So we're pulling in better than 1% every year just on yield. That's a nice thing to have. PE value isn't out of sight, especially when you consider what the PE for the market probably is right now, and there are so many different ways to measure market PE, but if we just talk about how we feel, I feel right now that the PE values are higher than they normally are as I've been investing for the last 30 years. I feel that 21 average is probably a reasonable PE given the kind of PE that the market is carrying. I'm looking at growth, and there's probably the elephant in the room. That's probably the reason why our par isn't sitting 5 points above the market right now. The growth that we're looking at, the sales growth that we're looking at in the portfolio, it's a little bit low. Nicholson kept repeating that if you really wanted to beat the market by 5 points, you probably needed sales growth somewhere around 11.5, 12.5, maybe even 13% for your portfolio. And here we are down under 10%. Now, some of that, again, has to do with some of these deep cyclicals that we've put some of our money in. They show slower long-term growth, but they can show explosive growth from trough to peak on a cycle. But if there's anything that we need to do, it's to take a look at our growth and move some of the companies with slower growth out of the portfolio and give a little bit more room for some faster growth, which will up the growth number, but it'll probably also up the par number as well. All in all, I would grade this portfolio right now probably something around a B+. There's room for improvement. There's some things we can do. And Mark, why don't you show some of the suggestions for moving these numbers in a better position?
Yeah, what we basically can do is take any portfolio, switch it to a worksheet or even in the portfolio format, and click on the return forecast. In this case, the projected annual return. This column, clicking on this sorts them from lowest to highest. So one of the, I think it's a fairly common best practice in many investment clubs to take the portfolio, sort, and basically begin debating, what are the lowest return forecasts in the portfolio? What companies do we have the lowest expectations for? And what we've done here is laid out a little bit more detail on a couple at the bottom, and I'm going to actually recommend that we part ways with at least the first two. Do you see anything else on that list, either Hugh or Ken, that is reaching out and grabbing you at this point?
Well, Mark, I'm loath to have held energy stocks all the way through all the down movement in the market in energy stocks, only to sell them before energy might finally be stabilizing and moving in the other direction. So I would not touch Dril-Quip. And I'm looking down past there. I'm noticing that a few of these stocks have hit 52-week highs or all-time highs. Stryker just hit a 52-week high in the last day or so. Whole Foods is having a lot of chatter about being acquired by Anderson, and if that should happen eventually, then I think you're going to see the Whole Foods market price move up. But I don't see much else on this list. I think Deere has the potential to move just like Caterpillar or ConocoPhillips or BP has, so I think we leave that in, but I do like the fact that we're considering freezing now the position in Varian Medical, which has spun off a pretty good chunk of its business, and I usually don't like to hold on to what's left of a company after it's done a major spin-off, and I'm not very interested, many times at least, in holding off to the spin-off company either. And then Panera Bread's being acquired. So that's a nice profit, which we should take. Remember, if you wait till the deal actually settles, there's always the possibility that the deal can be scuttled, and then that price on that company will move back to where it was before the deal was announced. Panera is going to be taken private. It's going to be held by a private restaurant chain. And, if you would have asked me 2 minutes ago, I could have told you what some of the other restaurants in that chain are, but I'm drawing a blank right now, Mark, as to what are some of the other restaurants in the Panera.
That includes Caribou Coffee.
Okay, all right.
I guess, Hugh, I'd reach out to you as far as Dril-Quip. I mean, we held on to some of the energy patch companies through the bad times and have actually seen a pretty good rebound. Dril-Quip is up for a fundamental company report update in the next week, so we have to at least hold on to it to see if expectations change. What's your general look on the energy patch?
Oh, I think oil is probably just going to languish at $50 for a while. I mean, the whole oil industry just keeps growing at about 1 million barrels a year. Has done for a long time, and I don't see why it shouldn't continue. And they're going to continue to drill in the U.S. and fracking will continue for gas. But yeah, it's not going to have the boom that it had 5 years ago, but it'll continue to roll along, I think.
Okay. Yeah, so we'll hold and we'll talk about Dril-Quip in greater detail, especially if it's still anywhere near this position. And by the way, for those of you that hold shares in Stryker, they beat earnings and sales expectations after the bell tonight. Well, here's a look at the Varian Medical position, just to give you guys some idea of what one of these things looks like. As it turns out, Ken picked it for the October roundtable back in 2011 at a price of 46. It's now at 88.37. So he's actually picked up $921 on the original core investment. And in January of this year, they spun off the Varix Systems. Actually a pretty good size spin-off of about 15 or 20% of the whole company. And the net of that, again, this is a one-timer. $1,000 invested originally in Varian Medical is now worth that combination there of about $2,200. Is that what I'm seeing there? About $2,200. And in just kind of auditing and checking through the numbers, I mean, we're left with a company in low single-digit growth rate. The bump up in stock price, it's actually up considerably in the last month that you can see from here to here, or at least since the last value line update. The return forecast is down in low single digits. You know, based on the assumptions that you see here, the one major difference between the value line report and this current auditing of the figures is this 15 down here. The outlook on the street from places like Morningstar and S&P and others has actually brought that average down. We used an analyst consensus for that type of a thing, and the other research entities are a little bit more pessimistic about the future PE ratio for Varian, than, especially with that lower growth rate. They get quite a boost in earnings, and one of the reasons we shared this in this format is just to point out that, you know, that's basically a shift in business model. They spun off a lower margin part of the business. The resulting business after the spinoff is projected to be a much higher number that you see out there in 2021, and that's not the value line analysts partaking of illegal adult substances or anything like that to get to that big red bar. It really is an analysis of the business that they could actually generate those type of numbers feasibly in the future. The PE ratio has matured and moderated, and the long and short of the whole company down at the bottom, just checking in to see what some of the opinions are at the current price of $88.37. You can see we've got a low single-digit return forecast. Nothing to get terribly excited about there. Value line checks in at not much higher. Morningstar basically has them fairly valued, which again would be something in a 7 to 8% return forecast range. S&P thinks they're overvalued slightly. And over in these two numbers, the analyst consensus and the S&P expectations for the next 52 weeks basically say that this is a company that's probably going to languish in stock price. Again, we look at this just to give us a feel for which way the wind might be blowing, or if we look down here and we saw Morningstar had a price to fair value ratio of 60, we'd certainly begin to question our work. Want to basically audit and that sort of thing. But again, I think we see a situation where I think we high five and say congratulations, Ken, on another winner.
They've been few and far between the last couple of years, Mark, so thank you.
Yeah, you have been in a bit of a slump, but I have a lot of faith in the big guy.
All right.
All right, so I would propose we go ahead and remove that one from the portfolio and just kind of do a little bit of spring cleaning. Any objections?
I have no problems with that, and no problems with removing Panera too. My practice usually is when a company is entered into an agreement to be acquired that I usually want to sell it, even if it might be a dime or 15 cents beneath the acquisition price, because I do know what will happen if, in fact, the deal falls apart. And there have been times when, the deal's been in place for 5, 6, 7 months, and then it does fall apart. So I love to take these three positions right here. It doesn't say who, yes, it does say who made them. One from me and one from the audience and one from you, Mark. And it's time to close up shop on the three of them. They've had nice runs and nice relative returns.
I just wanted to point out that one of the three was more patient and waited for a better price, but didn't want to dwell on that too much. So not bad, though. I mean, these are 2013, 2014 selections. Everybody can see the news there. And I'm with Ken. I don't remember the company, but about a year ago we were looking at a company that had shot up like 100% stock price. The deal fell apart, and it just went back where it started. That can happen. It's not science fiction. So I think we, again, high five 3 times and run around the cooler, including the audience on this one. And who knows?
Good idea.
We do enough of this, we could catch up to McManus.
All right.
All right, and here's the other one that we're going to talk about. Ken and I are digging in a little bit deeper. Ken and I are actually making a presentation on the concept of, doing the stuff we were just talking about, which is portfolio centered, using the stock selection guide return forecast to help with the decision making. But this thing that we'd been discussing for the last year or so, of especially during the first year of holding period, watching these companies that just swoon and basically don't keep up with the market. And we actually have 3 of them in the portfolio right now that cause us to scratch our heads a little bit. Tractor Supply, which has actually lagged the market by 38% since last July. Novo, which I thought was one of the best selections I'd seen in a very long time, and it still very well could be, but that one is also down 30%. And then LKQ is down 19%. Now, in the case of LKQ and Tractor Supply, their stock selection guides, the analysis still look pretty good. They've got pretty decent return forecasts. It's pretty easy to justify a hold. Novo Nordisk is a little bit more challenging. Their fundamentals have been ratcheted downward. A little bit lower growth expectations could be just a glitch. You can see that long-term price chart that's embedded there on the lower right. This is, in the case of Novo, this is an anomaly. The company's been on quite a run for many years, and wow, we really gotten stung. It looks like maybe it's settling out and stabilizing a little bit, but the expectations are not what we would hope for. When the stock price goes down and the return forecast does not go up, it's just not a very good picture. And the one thing that we're going to look at expanding in greater detail is to pay more attention to not just how has the company performed versus the market, but how is it done versus its industry. And in the case of LKQ, you can see that insert there from big charts on the lower left. This is the industry group that the Wall Street Journal and Dow Jones sticks LKQ in. And just as a quick check on how has that industry done since the time of selection last October, I believe it was. Yes, October, about 6 months ago. Well, that group has actually gone up 6 to 7% that you see down here. You know, during a period when the market went up almost 10. And the reason we're going to track this is, and I think it's going to actually be something to support a thesis for holding on to Novo. And maybe, Hugh, you can jump in on this one. International drugs, all the stuff in that industry group probably have lagged pretty significantly. I know the Tevas have lagged, a number of companies. So Novo might actually just be kind of in a gravitational field of companies that have swooned while the stock market has advanced since the election. And we want to kind of measure that, measuring not just the relative return versus the market, but how's it done versus the group. Any thoughts on that, Hugh? Is it the global outlook for pharmaceuticals, has that been pretty sluggish?
Hugh, you might be muted if you're trying to speak.
Can you hear me now?
Yes, we can.
I was talking away to an audience of one there. No, I think it looks very positive because I'm looking at emerging markets like China, where the middle class is really coming into its own quite aggressively. And growth there is going to be quite explosive. So I think this is a really rosy time for the pharmaceutical industry, not to mention the fact that, number one, there are a lot of diseases, particularly in the area of cancer, that are looking like ripe targets for some really interesting therapies. And number two, demographics. The baby boomers are getting older, and older people spend a lot of money on pharmaceutical products. So I think all in all, it's quite rosy for the pharmaceutical industry.
Yeah, I think.
Mark,
go ahead.
Mark, I'm going to ask a question, and either one of you can try to answer it maybe. I know Novo Nordisk is a Danish company, but it sells a huge amount of its product in the United States. Is the stronger dollar something contributing to the problems that Novo might be having? It would seem to me that it would make the product more profitable, not less. But I see that they really have their revenues have really tailed off.
Yeah, and they're doing.
How do they report the revenues in dollars?
Yeah, this is all reported in dollars as far as I know for now.
And then you would have to look at what percent of the revenues come from the U.S. versus elsewhere.
Yeah.
It could be the revenues elsewhere that are dragging it down because of the exchange rate changes.
There are a number of issues there, and I think the exchange rate is one of them, but Novo is also doing some product portfolio realignment, selling off a few things. They're doing some work in the vaccine area, which is probably causing some unrest and uncertainty in the market. And all of that stuff adds up to, I think, what we're seeing. But I do think we're going to see this as an example of many of the companies in the group. And I agree 100% with you, Hugh, on the long-term outlook, but that they do seem to have underperformed as a group in the last few months. And I think that's what it's going to bear out, that Novo is not behaving a whole lot differently. I go back and compare this to a thing that some work, and I'll share this in Cincinnati, and some work on Clayton Homes, when people were beating up on Clayton Homes a few years ago. And I pointed out that the entire manufactured housing industry was just getting completely hammered, and that Clayton was actually heads and shoulders above, even though they were lagging the market by a fair amount. So it can be one of those things where keeping our finger on the best of the best within an industry group makes a whole lot of sense. And I think Ken and I will end up there and be able to share some fairly concrete case studies on how this could be done and how we could justify holding on to a company like Novo. You know, Novo is actually down, what's it say here, 20% since time of selection. So, and you can obviously see it on the chart.
I love the approach, Mark, of looking for the best of a bad bunch, and have been successful personally doing that. For two reasons. You know, the best of a bad bunch, their fundamentals really stand out if they traded a slightly higher PE, they've slightly higher growth, they've lower cost, etc., all of those things. But it forces you to delve into why that company's doing well and why the others aren't doing as well. And then you learn the specific drivers in a given industry that drive a company, and that really sticks with you. And certainly for me in the airline industry, it means that many times I've avoided getting into buying a company that looks like it might be good, because I know the fundamentals of the industry now and have understood when things are good and when things are really bad.
Absolutely. All right, let's go ahead and table this, and we'll march on. We can come back if the audience has any questions a little bit later on. We'll go ahead and start the stock presentations, and since I handed in my homework first this week, or this month, I get to go first. So let's go ahead and crank this one out. I'm going to actually choose Home Shopping Network, which is not an area I have a lot of expertise in. It is an area where I have some expertise in taking control of the remote to prevent our credit cards from being used to make fairly quick decisions from the other couch. And I do want to just kind of point out that I really like the way this one is laying out, and I'm going to do something that's not easy for me to do, but I'm going to actually give credit for an idea to Ken Kavula.
All right, yay, hooray.
Back around the Super Bowl, back in 2012, he was sitting there talking about the remote, and we actually wrote some features back around that time frame, and it ultimately led to the selection of this Universal Electronics, ticker symbol UEIC. We featured it 5 years ago, almost to the date, at a stock price of 16. It's now up huge, and the annualized rate of return on that one is like 34%. And that one felt right to me. I've told you guys over the years, every once in a while you just have this feeling that a selection is pretty good. Another one that comes to mind is not Garmin, but the company who actually put the maps together for Garmin when we picked it. And basically the GPS map company that was providing services to everybody turned out to be the biggest winner of all, and that one really felt right also. And I guess I'm just nodding and paying homage to this notion of Warren Buffett and some of his cohorts that talk about you don't have 20 great ideas every day, and certainly not before lunch. And he and Charlie often talk about this personal punch card or dance card. You only have a limited number of times over a lifetime of investing, and I would invite everybody to check out that as a public link. Down at the bottom there, the cover story we wrote back in November 2011, which just kind of underscores this. But again, it was an idea that Ken brought at the time, and the two ideas come together where when we're talking about Home Shopping Network and the damage it could do to my checkbook if I don't control the remote. The other place of inspiration that kind of comes in is, just driving up and down our cul-de-sac and noticing that some of the houses on the street begin to resemble this from time to time, especially during the holidays. But there's an awful lot of home deliveries happening, and it's not something that's slowing down. And Home Shopping Network is obviously a part of that. Mobile sales are on the increase. One of the things I think we're seeing as a secular challenge across the board is the millennials and people down around that generation are not as big a consumers as many of us are, or historically. And it basically becomes a challenge of where do they shop and how, and this is where they're doing much of it. I mean, I came home just yesterday to 5 or 6 boxes on the front porch for our son that he had ordered from Amazon. So again, this is a big part of it, and just encourage everybody to give some thought to that. Here's a quick look at one of the slides from the Investor Relations presentation that you can get to at the Home Shopping Network Investor Relations site. And this basically illustrates why my wife doesn't have a chance, because she fits so many of these categories, and they're definitely coming for her. And they're coming for people like her, and they're doing it very successfully, as we're going to see when we take a look at the business model analysis here in a minute. But they're definitely coming for her, and she doesn't have a chance. I suspect many of the ladies in the audience also fit that category. It actually came up, and I don't usually feature or zoom in on the weekly update, because again, you're talking about 1/13 of all companies. These are the companies that are just in this week's update at Value Line. And what I've listed here again is the long and short situation, where we're focusing on the quality and the projected returns, and a little bit of cross-referencing to some of the long-term perspectives from Morningstar, S&P, and shorter-term perspectives from the analyst consensus and S&P and Goldman Sachs at the very end. But Home Shopping Network actually comes in pretty good here with a decent return forecast, good quality, possibly improving, and a pretty good outlook for the next year. And pretty strong outlook. And there's some other companies on here that are probably worthy of consideration. TGX was one of the first companies picked for the tracking portfolio back in almost 7 years ago, and that still looks pretty good these days. Nike, for people that are not willing to set their hair on fire too much. And then up at the top, I think Under Armour is still intriguing for those that have a speculative bone in their body. And then last but not least, up at the very top, Ulta Beauty has been extremely good to both Susan Michelik and Ken. Ken picked it at the National Convention last year as the stock for I believe in the roundtable session. Still looks pretty good, even though there's a little bit of analyst dissension on that one. And here's kind of the whole story as to why you would go look here from a secular or larger theme. And I've just lumped these 3 companies into what I'm calling home delivery. Now, I know they're not direct competitors or whatever. I'm just saying, if you look at the commerce done by these 3 companies, and obviously sometimes they double up and Amazon uses FedEx, et cetera, et cetera. But as you go back and look at since the Great Recession, back on the left-hand side, you can see definitely there was quite a bit of a downdraft here, or at least a flat spot. The home delivery enterprises have actually been going great guns, up 12 to 13% per year, and these have actually been bolstering or strengthening here in the last couple of years. And for those of you wondering, UPS and FedEx revenues basically add up to Amazon's. Amazon is as big as the 2 of them combined. So here's a look at the actual study for Home Shopping Network. Again, we're talking about a company that's been fairly well entrenched. The major milestones that I would cite here on the sales growth forecast, Value Line for some reason has a little bit more ambitious expectation, up in the 6 to 7% range. This trend line right here is 3.5%, and it seems to fit pretty good. So about 3.5%. So again, it's fairly mature, even though it's a fairly young company. Again, on the retail side of things, pretty good numbers here at 4.5% or so. You can see here's the longer term picture, and I think it's fairly easy to defend a number somewhere in this range. So 4.5%. On the PE side, again, I think it's fairly easy to defend a number in the 15 give or take range, and that's what we're seeing here. And under that set of assumptions, those three major milestones, we're basically talking about a return forecast somewhere in the low teens, which isn't all bad. And the most recent value line report in the current update cycle actually has the low total return forecast at 17. So they're actually pretty ambitious about expectations for this company. And I basically like what I'm seeing. Also, you don't see too many situations where recommended by Watson. That's straight off that Home Shopping Network page. Here's a look at what's been happening. Again, with the stuff Ken was mentioning a few minutes ago about the sluggishness in the retail, especially the retail discretionary sector. Over the last year or so, it's been a pretty good downdraft in many companies, and Home Shopping Network did not escape that carnage. Quality's actually been hanging in there pretty good, but again, what we look for is this formation that we're seeing over here, and that means the return forecast is at multi-year highs, somewhere in that low teens area after that drop in price. So the drop in price combined with a continued fairly strong recovery in the fundamentals, not a bad situation. You've got a decent return forecast. Here's a look at the stock price since they came public in the teeth of the Great Recession, and you can see they've suffered pretty well during that first year or so. Probably some restricted shares being sold and all kinds of things going on in that first downdraft that you see on the left-hand side, but they've been fairly steady for years. You can see that they're showing up as potentially oversold now after that downdraft in stock price that's happened for a little over a year now. I would argue that it looks like they may be putting in a little bit of a bottom. There could be some support in the low 30s on that chart. So I'm going to add Home Shopping Network. I fully realize that this one could continue to be a bit of a roller coaster if the discretionary sector doesn't wake up. It could be some period of time, but in it for the long haul, and I think they've got a pretty good grasp of their market and a pretty good outlook going forward. So we'll add them to the tracking portfolio. So with that, I'm going to go ahead and hand off to Hugh McManus. Now, Bristol-Myers didn't make this list. I just did a quick sort as we often do, just pointing out that he likes to find companies near their 52-week low. But we'll let Hugh go ahead and take it away.
Yeah, I'm unmuted. Thanks, Mark. Yeah, I mean, it's not quite near its 52-week low. I think it's trading at about $53 a share today, so its 52-week low is around 44, 45, somewhere in that range, but it's close enough. And certainly close compared to some of the other companies that I've already bought. So I thought I bought Bristol-Myers Squibb at least one time before, 8-9 months ago, so I thought I would add it into the portfolio again. It has a decent dividend. The yield is almost 3%, always a very nice sign. And the price has been fluctuating very interestingly recently. I would like it to be lower, but what can you do? Just buy it when you can. And I think if you skip on to the next page, you'll see its trend over the last 10 years. So you can see certainly in the last 12 months something happened. And it was bad news out of a clinical trial, which is one of the good things about this pharmaceutical industry. If you're convinced it's a stable company with long-term prospects, it can overreact, the stock price that is, buyers and sellers in the market, can overreact to short-term news. And certainly BMS has a very strong portfolio of drugs coming down the pipe. It has some very nice drugs already on the market, and while some of the promises of its pipeline weren't met with the failure of a clinical trial, it keeps on motoring along with new trials. And many of the slides you're about to see I took from a Bristol-Myers presentation that was given to Cowen and Company about 5-6 weeks ago. So if we move on to the very next slide, and the pipeline is the future, and since we're long-term investors looking forward, the beauty about a pipeline is that you can actually see, in embryonic form at least, what the company might look like 5-10 years down the road. And Bristol-Myers Squibb has pivoted and is focused on a number of distinct areas, cardiovascular, which has gone out of popularity among many pharmaceutical companies. But the big area is in oncology, cancer, and immunosciences, and immuno-oncology, which is basically bolstering our own immune system to fight cancer itself. Because fibrotic diseases as well, scarring, tissue scarring, which can be deadly, and some genetically defined diseases, although they don't seem to be as big in the portfolio. So if we skip to the next slide, one of the surprising things is that Bristol-Myers Squibb is no longer a giant. I've given the link as to where I got this information. It's a very interesting story to read, but you can certainly see that BMY, Bristol-Myers Squibb, the ticker symbol is BMY, is just knocking on the door of the top 10 now. It's, I think, in position 11. And there are some companies there that, you know, 10, 20 years ago weren't even near the top 10, Amgen and Gilead being one of them. And this list is a little bit confusing because they have Gilead in 9th place, but it really based on where its revenues are falling. The revenues are the numbers in the black box, 29.9 billion. It really should be in position number 7, but that's explained actually in the article. Most of these companies, or a big chunk of them, are US based, and the rest are Europe, but in the future, as I pointed out earlier, you're going to start to see the emergence of the Chinese pharmaceutical industry. It's in very early stage yet, but it's on the horizon. And if we skip to the next page, it's very hard to read, and you can download this presentation and it might be easier, but it lists the top 15 companies. Eli Lilly and GlaxoSmithKline are outside of the top 10. They're down in 14 and 15 respectively, but they're quite large companies. But this is an interesting chart because it shows the percent of the revenue that come from the pharmaceutical industry. It talks about the R&D effort and the amount of money that they put into R&D, and there's an important mistake in this table, so it's worth noting that. And it looks at some other statistics as it breaks down and carves out. I liken this to looking at French Impressionist painting. You have to look at it from a whole lot of different angles, and you see different things when you do that. And that's one of the reasons for carving up financials into different kinds of ratios, comparing them one to the other. But it's just outside the top 10. But the interesting figure is on the third column from the left after the names, which shows that it's growing. Its revenues are growing at 17% a year. It's the highest in this bunch, by the way. And on the next page, I just wanted to highlight, I know this is a hard one to read, but on the next page, I blow it up a little bit to show you that they claim, Bristol-Myers Squibb is number 11 there, they claim that the R&D spend, which is about the 5th column over, is 535 million, and of course, that figure is not accurate at all, and I wasn't able to figure out from the article where it came from. That would be an atrociously small percent of revenue, which is 19.4 billion. In fact, the company spends close to a quarter of its revenue in R&D, as do most pharmaceutical companies. Eli Lilly and Merck spend a much larger percentage. They're about a third each, if I remember correctly. But BMS is up there. And according to this table, it is a weak R&D spend, but caveat emptor, you have to be very careful with these web articles, and a figure like that jumps out at you immediately, and if you're familiar with the pharmaceutical industry, you would know, of course, that it's not accurate at all. So we skip along to the next slide. One of the things that the company likes to claim is that it's highly productive, and it is. One of the very interesting things about Bristol-Myers Squibb, and I'll talk about this later in the presentation, is that it actually hasn't discovered a drug of its own in maybe close to 30 years. And that's an outrageous claim, but many of the drugs in its pipeline it has acquired. I can't think of any drug that it has brought forward from a discovery lab right into the clinic and then on to market. Everything has been bought, or you can track the lineage of a drug to a company that it has bought. But having said that, it doesn't really matter where the drugs come from. The company clearly knows what it's doing. It has a strong pipeline, and it continues to replenish that pipeline over time. And that's the key point. But it has very strong R&D spend. In terms of approvals, which is the second box, its approval rate is higher than the industry average. And this is not really an apples-to-apples comparison, because what they're doing is they're taking an already successful franchise in the immuno-oncology business and then tweaking it for different types of cancers. And of course, once you have a drug that works in one area, chances are, if it's done correctly, it can work in another. So the approval rate for a new indication can be quite high. But if we skip on to the next slide, they really focus in on their immuno-oncology work here. And Opdivo, these are what are called monoclonal antibodies. They acquired these drugs from an acquisition about 15 years ago. And today, interestingly, about between 70 and 80% of its development pipeline are large molecule drugs and not the classic small molecule drugs, the Tylenols and aspirins of the world that we all know and love. These are now immunotherapy. These are now large molecule drugs that generally have to be given by injection in a controlled hospital environment or clinical environment. But the news they want to boast here is that of their 15 phase 3 clinical trials, 5 of them were stopped. That usually indicates something bad, but in this case it was good because the trials were so successful, and that the idea is that there is a moral issue here. If it's clear that the drug works, you really have to start administering it to sick and needy people. So it was stopped due to survival benefit, so they could move along to the next stage. And they have got breakthrough therapy designation for 7 of the drugs, and that's quite a big deal. It's a designation which the Food and Drug Administration gives, and now many other national agencies give, and it's a way to expedite the development and review of drugs. And what you have to do to get breakthrough therapy is you have to demonstrate substantial upside, substantial benefit over existing therapy, and presumably the drug has a nice clean clinical profile as well with very few side effects. But if you have that, and it's definitely a winner, the FDA will move things pretty quickly for you. Still have to do all of the same tests, same clinical trials, but they're done in a more expedited fashion, and sometimes you even get to look at surrogate endpoints, something else that might indicate success rather than survival. So we skip along to the next slide. It has a number of clinical winners in the franchise of anticoagulants, new oral anticoagulants. They're big into that market with their Yervoy, which is a MAB, and Opdivo, which is a small molecule. Oh, it's a MAB as well. It's Eliquis, which is a small molecule. Yervoy and Opdivo are large molecules. But it's doing really well. And it has a 17% year-over-year growth in 2006 in these 3 of the largest areas, which are doing exceptionally well. If we skip along to the next slide, the company wants to stress that it is focused relentlessly on shareholder value. All love to hear that. Hard to do often, but that's what they're doing. They have a lot of cash in the balance sheet, $9 billion. Might suggest yet another acquisition by the company, but they have a number of partnerships and really have kicked the tires of a number of good partners, and we'll know whether or not it makes sense to buy it. They are doing opportunistic share repurchases, and now is a good time with the stock price fluctuating near a 52-week low. They right now have $2 billion set aside for accelerated stock repurchase plans, and they're doing, this doesn't make a lot of sense to me, but additional 10b5-1 and repurchases, and I always learn that a 10b5-1 is actually a planned sale by company insiders at given intervals in time and set prices or price ranges. But I will have to look up exactly what they mean by a 10b5-1 repurchase. And it has had 8 years of dividend increases. The Great Recession ruined a wonderful track record for BMS and for many other companies that had to retrench 8 years ago. I don't really hold it against them for slashing the dividend a little bit. Everyone did it, or many companies did it. But they're back on track to dividend growth, and as I mentioned earlier, it's close to a 3% yield at the moment. I think about maybe 2.8 something percent. So if we go ahead to the next slide, it talks here about an important area. It's very hard not to crack for pharmaceutical companies, which is non-small cell lung cancer. Lung cancer, a horrible disease that kills 90% of people that are that get the disease. It's really one of the areas where a lot of R&D effort is being spent, because really want to try to crack this one. Checkmate is the name of their clinical trials, and they have a number of Checkmate trials going. And the point of this story is to show that there are a number of events coming up for Opdivo as a monotherapy. It's already approved in different areas, but there are dual therapies and other therapies using their existing franchise that they believe will be approved later in the year, early next year, and into 2018, 19, 20, all the way to 22. So their existing portfolio is being repositioned for other markets, if you will, kind of a very clinical way, no pun, of describing a horrible thing, cancer. Now, that's what you do in this industry. You kind of distance yourself from it a little bit. Just the dispassion of objectivity. We move on to the next slide. They are seeing continuing growth in these portfolios, and they're stressing that again. The expected timing column on the far right shows when some of these trials for different types of cancer will come to fruition, or are approval events. And really, they're really making hay with Opdivo and Yervoy. So we move on. I think we're going to wrap this up soon. The one thing that they do like to stress in all their presentations is the fact that the portfolio that they're developing, which is true, it's very complementary to the drugs they already have in the market, whether it's in cardiovascular, in the immunosciences in general, or fibrotic diseases. And they have quite a strong portfolio in fibrotic disease. The big new area for the last 5-6 years is NASH, which is a liver disease. It's come out of nowhere. They've discovered this NASH problem that many people have with their livers, and it can actually be quite deadly. A lot of people get it, but it was very underdiagnosed for many years. But if you start looking at the pipelines of many emerging companies, small companies, you will see a lot of effort has not been dedicated towards NASH. And idiopathic pulmonary fibrosis, which is another lung disease, which is gaining prominence. These are the two big areas of a lot of companies. My only concern here is that they will have a lot of competition in this area. As I said, a lot of people are paying attention to fibrotic disease. But in immunoscience, they're really doing spectacularly well. And if we skip along to the next slide, wrap up soon. One of the things, as I mentioned before, is that Eli Lilly partners like crazy, and they buy lots of companies. In fact, I think Eli Lilly, over the last 30 years, you can trace back its pedigree to about 80 or 90 small companies that it has acquired. Most major pharmaceutical companies are like that. But BMS stands out, I think, as a company that has acquired its pipeline over the last 20 to 30 years. Now that I've said that, somebody will probably contradict me, and they will have actually a drug that they've developed in-house from scratch. But last time I looked at it in detail, I couldn't find one. I'm not knocking the idea. Doesn't matter where you get your drugs from as long as you know what you're doing. And I think we'll be wrapping up soon. This slide needs updated, but it shows you where they are with some of their major drugs. They have many blockbusters, a blockbuster being a drug that sells over $1 billion a year. And this slide is about 6 or 7 months old. Eliquis and Yervoy are much larger, and Opdivo much larger than they were when this slide was presented. I didn't have time, sorry, to update it. And if we move along, the stock is down. There has been some less than positive news in the clinic about their leading drugs, but the fact of the matter is they are still doing well in melanoma. Glioblastoma, which is another area that's very hard to crack, didn't show any benefit, so the company took a nosedive as a result. But while there are short-term hiccups, I think the long-term prospect for this company looks good. And for that reason, with the stock price depressed at the moment, and maybe we'll even get more depressed, I hope, it's not a bad time to buy. So if we go on, I think, to the last slide, just sums it up. I'd like to add more Bristol-Myers Squibb to the portfolio.
Well, thanks, Hugh. Yeah, it's a one-time selection, so this will make it a two-timer. And possible opportunity for accumulation based on the stuff you've shared. Thank you. All right, let's go ahead and wrap things up with Maximus. Go ahead, take us away, Ken.
Okay, when I'm buying a stock, and for full disclosure, I own Maximus in my own personal portfolio, in an IRA portfolio actually, and When I buy a stock, I like to put a thesis behind it. I like to have an idea why I'm purchasing it in the first place, and then if it runs into some trouble, I can test the trouble that it's running into against my thesis. My original thesis on MAXIMUS was that we had a new healthcare system. I bought it about 2.5 years ago, and the new healthcare system was the Affordable Care Act, sometimes known as Obamacare. And it was extremely complicated. In fact, our new president just made the comment that healthcare is very complicated. So I think it's important for us to understand that as we create these laws, here's an editorial comment, as we create these laws that nobody even reads before they vote on them, we create a lot of complex regulations that have to be written. And if the regulations get to be so complex that they can't be run by government agencies, then we have to hire administration. And that's what MAXIMUS is in the business of doing, administering various types of plans that have been passed by county governments, state governments, federal governments, national governments throughout the world. They have a worldwide presence in this administrative capacity. Maximum, and Mark, you can click again if you would. MAXIMUS did give us a lot of business, or did receive a lot of business in the Affordable Care Act. And now as we're moving into a place where the Affordable Care Act is running into some issues with some of the healthcare exchanges stopping service in some states, MAXIMUS is losing a little bit of the business. But MAXIMUS makes 3 points about their company and about the business that they're involved with. And those 3 points are from a presentation that you can look at right on their website, and that's what this slide is from. The first point is that macro drivers aren't going away. And you can read the rest of that first paragraph yourself, but there's a lot of things that are working in favor of MAXIMUS. One of the biggest macro drivers that exists right now is a change by governments in the philosophy of how they're going to deal with healthcare. It used to be that you ran test after test after test, and sometimes when you were at the doctor, you got the feeling that they were running particular tests just so they could cover their rear ends and guard against being sued for not running all the tests they could possibly run. Well, governments are beginning to look at the models that they're using for healthcare, and they're saying maybe we should be looking at outcomes rather than what they do to you. Maybe we should be looking at wellness and whether or not the healthcare system and the doctor manages to keep you well, rather than offering all kinds of tests to find out what's wrong with you in the first place. This shift to wellness is going to be a major shift, and it's going to be very complicated to administer and to keep track of. MAXIMUS is kind of counting on that. Their second point is that the tendency of Republican governments at all levels, and they make this point a number of times as I read through their materials, Republican governments at all levels tend to favor outsourcing and public private partnerships as a vehicle for cost-effective solutions. I don't know if you're aware of it, but the majority of the states have Republican governors. They have at least one house of their legislature that's Republican. There are many states that are both houses Republican, and while these are not the necessarily large population states, they still need people to come in and partner with them when it comes to administration. That's a huge growth driver for this particular company. And then the last thing is a shift to more state-based management of public programs. You know, if you've been listening to all these debates about what's going to replace the Affordable Care Act, you know that there's going to be a plan to try to push away from a completely national health care plan and make these plans more unique state by state by state, so that you have 50 or 51 or 52 if you count Washington, D.C. and Puerto Rico, that you have state-based health plans, and they're all going to be a little bit different, and they're all going to require separate contracts for administration, and that, again, bodes well for this company. So MAXIMUS certainly has some growth drivers in place that probably aren't going to go away anytime soon. Mark, next slide, please. They have new awards as of September 30th of about $2.1 billion. So that's a fairly decent pipeline going forward. But they also had additional sales opportunities of $4.3 billion. They've been signing contracts at a pretty decent clip as they complete requests for proposals, RFPs. And the company feels that there's an awful lot of business out there that they still can attract, even as they lose pieces of their business from the Affordable Care Act. The transition from one healthcare system to the other might cause this company a little bit of problem, and for a small amount of time you might actually see a reduction in revenue and especially in margin. But those should, according to all the sources that I've read, those reductions in revenues and especially the reductions in margin, that's my dog who's very upset right now because we have thunder. All right, she's barking it away. But all in all, when it's said and done, the company should recover any margins that they lose, and they definitely should recover back to become revenue positive again going forward. Next slide, Mark. Value Line suggests that the company should return somewhere between 9 and 19%. Now, that's a pretty nice return in today's market. And I'm looking at the growth box from Value Line. They're suggesting revenue growth of about 13% and earnings growth of about 14%. So again, pretty strong numbers, especially for a company that is kind of juggling different contracts right now and replacing some business that's going away with other business that's being created brand new. Next slide, Mark. I love to go to the Eagle, and I want to see a steady or increasing quality line. That's that blue line right there. And then I want to see that the par values that come up on my studies end up being near historical high par values. I'd like to see that par somewhere in the mid-teens up into 20. I don't want to buy it at a par less than 10, most definitely. So I'm keeping my eye on where it was. I loved it back when the par was above 20 about 2 years ago, 2.5 years ago. My first purchase was made in that general area. But I think that we're looking at some other times right now, especially with all this talk about one healthcare system leaving and the other coming in, that's kind of driven MAXIMUS's price down a little bit, and that, of course, on a good company should increase the potential going forward. Next slide, please. This is the default study that's on the Manifest website. If you'll notice, the default sales growth is 14.3%. That's right in the same ballpark as Value Line, and the default PE value is around 17. That's a little bit more conservative than Value Line's PE call going forward. If you click again, Mark, I redid the study and I dropped the sales growth, the revenue growth, to around 12%, which I felt was more in line with what historically has been happening, puts me on the conservative side of reality. But I did, after studying the 10-year trend of PE values and the 5-year trend of PE values, of average PE values, I did decide that 18 was probably a call that I was more comfortable with than the 17. Remember that companies are fairly sensitive to PE values, so when they go up 1 or 2 points, that makes a lot of difference many times in what happens with their par values. I'm looking at the par value for this company with my 2 adjustments. I'm just under 13%. That's certainly 5 points above the market. The market, I said earlier in the session, was probably just under 6%. So I'd be interested in buying anything with a par of 11 or plus. I love the 12.9 par. I love the sales growth of 12%, which was one of the things that we were talking about that this portfolio needed. It needed companies that were going to grow in excess of 11.5 and upwards. We needed to move our sales from the 9-something that it was up, and by adding a 12%, one holding is not going to move it very far, but if we continue to focus on this sales growth, I think that we'll be able to push that up as well. So with all of that being said, I end with this paragraph, one more slide, Mark, from Value Line. I read an awful lot because I told you I do in fact own this company, and therefore I do a lot of reading. And this sentence that I have with the big circle around it is in almost every single analysis that I read about this company. You can read that sentence for yourself. But basically what it says in a real short form is that no matter what the healthcare system is going to be, we're going to need capable companies to administer these programs. Maximum is such a company. They've proved to be extremely capable, extremely reliable, and no matter what the government finally decides is going to be the system that we have, somebody's going to have to help pull the rules together and then make sure that people are following these rules. I just note that the report said that the company was ranked 3 for the year ahead. That rank has recently been changed to a 2 for the year ahead. So Value Line is more optimistic on the near term, and this paragraph says that they're already fairly optimistic on the long term for the company. I don't see too much not to recommend this being placed into the file. I certainly have always been a patient investor, as they mentioned in the first line, so I will patiently wait for Maximus to make us some money.
Thanks, Ken. All right, well, we'll go ahead and knock out the poll, and then we can field a couple of questions.
Okay, here we are with our poll, and if you give me just a second to press the right buttons here. And I've launched the poll. And what you can do now, folks, is you can use your mouse to pick out whether you'd like us to add a second position in Bristol-Myers or in Home Shopping Network or in Maximus. And I'm going to keep the poll open. I'd love to see about 75 or 80% of those of you that are here tonight voting. We're up to 60, we're up to 70%, 75%. So let's count in my head to about 5. We just went to 85%. 1, 2, I'm going to close the poll down. And if I can find the right button, there we go, close the poll down. And it looks like Maximus just edged out Bristol-Myers. I have to show it, don't I? There we go. It looks like Bristol, or Maximus just edged out Bristol, 47 to 44%, 8% choosing Home Shopping, and a couple of folks don't like any of those three stocks. So,
I'm
Mark, if you'll double, you're crushed again, right, Mark?
I think we got to call that a tie. That's close enough for a runoff.
I don't have any problems calling that a tie and adding 2 positions for both of those, Mark.
We'll let the audience run with 2 of those.
Okay.
All right, let me go ahead and just a couple of things, and then we'll shut things down and take some questions. Ken and I will be in Minneapolis on May 6th. That's a Saturday for an all-day workshop session. We're looking forward to seeing the investors of Minnesota, and you're all welcome to come and check that out. And then all of us, all of the knights and several of the guest knights and damsels will be at the National Convention in Cincinnati on May 18th through the 21st, and we basically do this for 3 or 4 days and have a whole lot of fun sharing ideas and seeing some of the people from all around the country and spending some quality time with them over a few days. So that is in our future, and we'll be filling out the schedule with a few more events in the near future. But with that, we'll go ahead and thanks, guys, for your contributions tonight. We'll go ahead and close down the recording and stick around for some questions. Thanks, everybody.
Well, we're getting an I'm going to wait.